Okay, so let's get into the second tool of monetary policy that can be used by the Fed. Now, when I was a little kid, I used to think, hey, when I put my money away into a bank, they put it in this vault, it's kind of like a big piggy bank, and they say, here you go, here's your money. Well, that's obviously not the way it works. We know that the banking system is designed to have money in and essentially money out. All right, so in the United States, we have what's called a fractional reserve system. And this fractional reserve system, by the name itself, infers that when money goes into a bank, only a portion of that money must be held by the bank. So banks must hold a fraction of every dollar on a deposit. When people put money into the bank, they become what are called reserves. Reserves reflect money that the banks have, but they've not loaned out. And there are actually two types of reserves that we're going to talk about. But just remember that word reserve and, of course, this idea of a fractional system. In the United States, the Federal Reserve is responsible for monitoring the banking system and the financial sector. Now, what a reserve requirement is the percentage of each dollar that must be held by the banks in the event that lenders to the bank demand their deposits. In the United States, the Federal Reserve mandates that banks hold a percentage of each dollar in the event that there is a run on the bank or a panic. Which does. And that's a part of the federal government. So it's worth noting here that the Federal Deposit Insurance Corporation covers deposit accounts, that's checking and savings accounts, money market accounts, and CDs up to $250,000 per depositor. All right, let me familiarize you with what's called a T account. T account is a simplified way of looking at the assets and liabilities for a bank. But ultimately what a T account is, it represents the assets and liabilities for a bank. So for a bank, assets are essentially any reserves, that is money that they have that they could loan out, and any potential loans or loans that they have made. Reserves represent money that they have in their vault or on record with the Federal Reserve, and loans represent money that they have loaned out to someone that they have a claim to. Liabilities, on the other hand, represent money that they owe to depositors. So when you see these T accounts, you can see that they're split almost like a T. And what they have, again, is the assets on one side and liabilities on another side. I'll show you a sample for your response question, but sometimes what they'll do is they'll ask you information relative to the information on the T account. Okay, so T account represents reserves and liabilities. Reserves and loans are assets to the bank. That means that they have a claim to those things and they represent value to the bank. A liability, on the other hand, represents money that they owe to some depositor. So they are liable. They are responsible for this money. Now, from a very simplistic perspective, when you look at the total assets and total liabilities for the bank, they must equal each other. It's possible that the Federal Reserve could put more money into the reserves that wouldn't equal the liabilities, but money that has been deposited into this account, okay, whether it's this $10,000 here or this $100 here, they must equal each other because one person's deposit represents the bank's potential loans. All right, so let's talk a little more about how this works. All right, so we've established that the United States and other modern economies adopt what's called a fractional reserve system. In the United States, the percentage of each deposit that must be held by a bank is known as a reserve requirement. And of course, this again represents each deposit and how much the bank must hold. All right, so the banks must hold this supply of money in order to protect against runs or panics. See, the way the banking industry works is if you have 100 depositors, and each of those depositors, the bank must hold a little bit of their money and they can loan the rest. Those 100 depositors won't all go to the bank at one time in order to withdraw their money. And so the bank can rest assured that they won't have to satisfy those 100 depositors at one exact moment. But it could happen, and that's of course what's called a bank run or a bank panic. At any rate, in the United States, banks must hold 10% or 1/10 of every deposit on the M1 money supplies. or liquid accounts. And again, the Federal Reserve is responsible for regulating this percentage. So, this can influence how much money can be created from each deposit. That is, if the banks must hold more money in reserves, they can loan out less. So let's imagine that the Federal Reserve says you have to hold 10% of every deposit. Well, then they have to hold 10 cents to every dollar. They hold 10 cents, 90 cents can be loaned out. Imagine that they had to hold 50% of every M1 deposit. Well, then they would have to hold 50 cents to every dollar. Imagine they have to hold 100% of every deposit. Well, then they couldn't loan any money at all. So the higher the reserve, the less they can lend out. Subsequently, the lower the reserve, or a decrease in the required reserve ratio, the banks must hold less money and could ultimately loan out more. All right, so this brings us to how the Federal Reserve can impact the banking system relative to money creation. So each bank must hold a percentage of their deposits in the M1 money supply. This is called a required reserve, and that ratio is created by the Fed. Again, it's 1/10 or 10% of every M1 deposit. Anything they have left over is known as an excess reserve. The excess reserve can then be loaned out to other parties that can, of course, be for homes or for cars or for anything that potentially would be in money demand in the economy. To give you an example of how this would work, let's say we had a $1,000 deposit in a bank. The bank would be mandated to hold $100 in reserve, and so that would be to protect against runs or other demands on money from depositors. They would have an additional $900 left over for lending. So they'd have $100 in required reserves, $900 in excess reserves, and they could, of course, loan that money. And so this leads us to what's called the money multiplier. And that represents a mathematical theory to how much money can grow based on existing deposits and prospective loans. So the money multiplier formula helps us understand how much money can grow to based on this process of banks borrowing money from depositors and lending money to potential borrowers. The formula is the money multiplier is equal to 1 over the required reserve ratio. Or, let's say 1 over 0.10 gives us 10. Well, what does this 10 actually represent? The 10 represents the multiplier. So how much could a deposit grow to if banks were to loan all of their excess reserves? All right, well anyway, here's another example. Let's say that the required reserve ratio was 5%. Well, then the money multiplier would increase to 20%. 1 over 0.05 is 20. How is money created? Well, if you have an initial deposit, that deposit can then be loaned out, or at least a fraction of that deposit. So the fraction of deposit that's loaned out is then loaned out to other people who would deposit their money potentially in another bank, or at some point would be deposited in a bank. And that money could continue to generate more and more money. Okay, so the higher the required reserve ratio, the less the banks have to loan out. Let's look at an example. Let's say that I have one person, person A, and this person puts $2,000 into Bank of America. Well, Bank of America must hold 10% of this deposit, which would be $200 in their vault, or on record with the Federal Reserve. They would have $1,800 left over as a potential excess reserve, as a potential amount that they could loan. Let's imagine that they do loan this out to person B. And person B takes that money, and before they spend it, they deposit it into their bank, which is Wells Fargo. Well, we know that Wells Fargo is going to have to hold 10%. So let's say they hold $180. Wells Fargo, just like Bank of America, will have left over some excess reserves. And these excess reserves come from the original deposit. Let's say they have $620 left over. Okay, so Wells Fargo will have $1,620 left over. Let's say they loan the entire amount to person C. That $1,620 goes to person C, and person C's bank, SunTrust, has to hold 10%, $162. Well, then SunTrust is going to have in their excess reserves $1,458. And this process can continue to go on and on and on until this money runs out. Now, this is, again, a little bit of math theory, but it could potentially work this way. So you can see that in our example, with just 3 people depositing money, that the money supply grew to $54.20 off the original $2,000. And of course, in our required reserves are $542, the 10% of the $54.20. Now, what could this money grow to ultimately, this $2,000? This would be based on the money multiplier. 1 over 0.10 would give us 10. 2,000 times 10 would give us $20,000. So this initial deposit of $2,000 could actually grow to $20,000.